Well, happy Friday, August 2nd. Mark Milam here. Well, that was an interesting week. So we started out the week with our eyes on Wednesday, 2 p.m. for the Federal Reserve meeting. And this is really the first meeting that we've had in more than a year's time where it could have potentially been on the table that the Fed would cut the Fed funds rate. As a matter of fact, I was speaking to a group of realtors the day before the meeting, and I said, hey, don't discount the fact that the Fed might surprise the markets on Wednesday and cut the Fed funds rate by 1/4 of a point. It's not a high probability, but there's a puncher's chance. For the first time in over a year, there's a puncher's chance. That didn't happen. The Fed did not cut the Fed funds rate, but I'm wondering now, Friday afternoon, if they think maybe they should have, because we've gotten some labor data over the past 48 hours that would tend to indicate that we've got some significant softening in the labor market, and that was really the last shoe to drop. We've seen inflation drop smartly over the past 6 months. We're down with a 2 handle on the personal consumption expenditures, and we've seen the number for consumer price index come down as well. But let me show you what I'm talking about. I'll flip the screen around here. This is headlines from Wednesday, where the Fed holds rates steady, notes some progress on inflation, maybe gave a nod to a potential rate cut in September. Here's how we're doing today. The market responding positively. Remember, green days are good days. That's what we want. Mortgage-backed securities trading up in value, interest rates coming down. So what's behind this strong move on Friday as we close out the week? Well, it's this right here, the non-farm payrolls report. So the non-farm payrolls report, it's a government report from the Bureau of Labor Statistics, just says how many jobs we added over the past 30 days. Now, there's a little controversy behind this report because it's always the headline number that gets all the press. But then they go back and they revise that number 2 times over in the subsequent months. They revise the number, and those revisions historically have been down. In other words, over the past 18 months, 15 of those months, we've seen negative revisions to the non-farm payrolls number. So they've gotten it wrong to the high side 15 out of 18 times. It's not like this is balancing out over time. They're consistently high. So when you take a look at this number, we came in at 114,000 jobs created against an estimate of 175, and that caused the unemployment rate to tick up from 4.1 to 4.3%. That surprised the market. The market was not anticipating the unemployment rate to jump by 0.2 of a percentage point. In fact, our Federal Reserve has said that we're going to close out this year. Their forecast was that we would close out 2024 at a 4% unemployment rate. Well, as we turn the calendar from July to August, we're at 4.3%. We're already 0.3 of a percentage point higher in unemployment than the Fed's end of year forecast, and we're seeing weak job creation. But even that is not the end of the story. I'll flip the screen around again. We'll go here to the actual release this morning. You can see August 2nd for the non-farm payrolls report. You can see the unemployment rate at 4.3. We only added 114,000 jobs, but here we go all the way to the bottom of the report, and we get our revisions for the prior months. And we can see another downward revision for May. We revised down an additional 2,000 jobs, and then a downward revision for June of 27,000 jobs. That means, again, we were too high on these non-farm payroll report. And I'll bring this over here and show you this. This is the past several months actually the past year and a half, where you can see the first and the second revisions to the non-farm payrolls number. I've added in the minus 2,000 here for May, and we've got minus 27,000 for June. And you can see we really are missing to the downside substantially, which begs the question, if we're reporting now 114,000 jobs over the past 30 days, what's that going to get revised down to? How weak is the labor market really? I don't know if you saw the news on Intel, but Intel now slashing a significant portion of its workforce. We're going to see several tens of thousands of jobs lost there. This begs the question, did the Fed miss their window? Should they have cut on Wednesday of this past week versus punting to September the 18th? Remember now, we got September the 18th, and then the next meeting after that is November 7th. Guess what else happens in November? We elect a new president in November. So this is going to be a really interesting needle to thread for the Federal Reserve, and my hunch is, just like they were behind the curve on the way up when inflation was accelerating, perhaps now they're behind the curve on the way down as well. And I think now the last slide I'll show you is what futures traders are saying, is that suddenly we have a 72% chance, not of a 1/4 point rate cut in September, but of a half-point rate cut. In other words, the market now pricing in a half-point Fed funds rate cut comes September 18th, and that's probably what the market is saying, is that, hey, Fed, you really missed your window there on July 31st, and a half-point cut's going to be in order once we turn the calendar over to September. That's all great news for home buyers and homeowners because it just means mortgages are getting more affordable, and that's exactly what we need. Resale housing has been in a recession now for over 2 years. It's time to get out of that and get back to normalcy. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com.